and I believe a recession is going to take hold. The slowdown in the economy has been very, very gradual. I think it's going to persist. There's the next couple charts just down below where we are, Kerry, underscores this in terms of, again, looking at the labor market. The savings rate now, for instance, is down to 2.9%. Prior to the pandemic, it was about 5.5%, between 5 and 6%. So the economy is still moving forward, but there's a whole lot of people that are spending, but they're not saving because they don't have the extra income to be able to do it.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Hey, Jim Welsh of macrotides.com is with us. Today, he's got some revised charts hot off the Excel spreadsheet, or however he's doing it. And you're definitely going to want to look, dealing with market, with latest income, latest employment numbers, what it all means. Jim, welcome back. How are you?
It's great to join you, Kerry. I'm doing well. Hope you are too.
Okay, so let's get down and dirty here. We got these charts. By the way, if you're listening on the podcast, there will be a link in the show notes so you can download his latest, Jim's latest update here, so you can take a look at it firsthand. So what am I looking at here, Jim?
Well, basically, Kerry, the Fed meets on September 18th. They're going to cut the funds rate. The open question is, well, how much are they going to cut it? But I just thought for those listening in, as well as if they go and get the piece, they can look at this. What is the debate going to center around as the hawks and the doves on the FOMC discuss all this stuff? So the first one is the neutral rate, which is a theoretical concept of where is the level of the funds rate that is neither restrictive nor accommodative. There's no exact formula. So this is a best guess thing. And right now, the best guess is around 2.5%. So what we can see is in the pandemic, the Fed lowered the funds rate way below the neutral rate to, support the economy and so forth. When inflation broke out, they raised it comfortably above the neutral rate, which is a measure of how restrictive the FOMC is. And what's interesting, Kerry, is the doves think it might be closer to 2%, and the hawks think the neutral rate could be closer to 3%. And the reason why that debate is important is you measure the difference between the current funds rate and the neutral rate to determine just how restrictive policy is. But the bottom line here is both the hawks and the doves, Kerry, agree that the current level of the funds rate is a restrictive level, which is why both camps, hawks and doves, are on board to cutting the funds rate in coming meetings. So that's what they're going to be talking about. And then one of the things that they've talked about in prior meetings, and again, this is more the doves talking point, but the hawks acknowledge it, is that if you look at the core PCE, which is the Personal Consumption Expenditures Index, it excludes food and energy, that is probably the inflation metric that the FOMC pays more attention to than just about any other metric, like the CPI and so forth. So the point that they've made is that in July of last year, inflation was, I think, around 4%. It's dropped about 150 basis points. And the idea is, okay, the funds rate hasn't been changed at 5 3/8, but as inflation declines, the real rate, how much the funds rate is above the core PC, has increased, and that, in a sense, represents policy tightening. This is another point of agreement between the doves and hawks, like, okay, policy, even though we haven't done anything with the funds rate since July of last year, has been tightening because the real funds rate is going up. So these are the reasons why hawks and doves are both on board to lower the funds rate in not just in September, but in coming meetings.
All right. Let me ask you one question first. When you say the neutral rate, would that also be construed as the natural rate if they weren't messing around with interest rates in the first place, which maybe we would all be better off for?
Yeah, I agree with that point in terms of historically, the Fed really, in its best efforts, has not done a wonderful job in terms of the outcomes that they've generated. The natural rate, again, what it is what's the level of the funds rate that is neither restrictive or accommodative? And to me, calling it the natural rate makes sense too.
Okay. So that would be, if there was no Federal Reserve, this is what it would be. And so we think it's somewhere around
2.5%. Yeah. Now, for what it's worth, before the financial crisis, it was closer to 4.5%.
Mm-hmm.
So this thing changes. Obviously, we went through, after the financial crisis, an extended period of really muted inflation, sub 2%. And things like productivity would also enter into it. So it isn't, like I said, there is no precise formula. This is a best guess estimate.
Okay. So, yeah, because you can't know that because you would have to have a free market that would actually set it. So, in other words, you're saying that the Fed is like, according to this, it should be basically 2.875%.
Well, 2.5 would be the dead neutral. If you believe 2.5 is the natural or neutral rate, the funds rate would be down there. So that kind of tells us, where is it going over the next 12, 18 months? Mm-hmm. As they reduce the level of restrictiveness, that would be an endpoint of where they might get to. The speed with which they move from where they currently are down towards that 2.5 is going to be dictated by how much the economy slows and whether or not it goes into a recession.
And how much they panic. And you can't divorce political considerations here. They got to do something, because the only bright spot somewhat on the economic horizon has been the stock market. If it's going to start tanking, they're going to panic. We already have Greenspan on the audio saying that, not Greenspan, I'm sorry, I'm dating myself here. Powell, yes, Jerome Powell. I did know that. So we already got Powell on the record in background, somebody talking to like Project Veritas or something, saying that he hates Trump and he'll do anything to stop him from getting elected. So when we take into consideration the political backdrop, and that now they can really bring the rate down to zero, but there isn't that much time before the election, only 2 months. Don't you think they got to go for the biggest bang for the buck?
I'm not in that camp, in part because we've seen evidence, like the employment report that came out today, Kerry. Last week I wrote that, hey, we're going to see the unemployment rate probably tick down, job growth tick up. So job growth went from 114,000 to 142. Oh, wow, 28,000 increase, right? Mm-hmm. Well, they revised July and June down by 86,000. And I think the stock market is responding to that weakness. Wait a second, that number headline looked fine, but underneath it, not so good. So my point is, if the Fed moves, even if they go 50 basis points, I think they're going to go 25. But even if they go 50, some people might start to think, what does the Fed see that we don't see? In other words, is the economy slower than expected? So perversely, if they went more aggressively at this point in time, I think the stock market would react more negatively, not positive. If they go 25, one interpretation could be, okay, the Fed still thinks everything is okay. No need to go more than 25. So that's my take. I really, again, I pay very close attention to the minutes of the Fed and all the rest of it. I've been probably more right than most people in the country.
I agree with that.
Policy.
No argument. But, I'll just go back, and we've talked about this before. The late, great Alan Abelson, who was who was the chief editor at Barron's.
Yep.
I remember him once commenting saying, the Fed is doing what it does best, which is getting a president reelected. And hey, everybody in Washington wants to increase their own power to be able to do whatever they want with minimal oversight. And, their allegiances here are very obvious, Jim. They're really
I'm not, again, I'm pretty confident that each of the Fed members has their own political bias. Maybe I'm naive enough to think that they're in a position where they're looking out over the next 1 to 3 years in terms of QE, and that they're going to try to do the right thing. Right now, the right thing is cutting by 25. If we get some more data that is weaker than expected, maybe they go 50. I just don't see.
All right.
And the next meeting is it's the day after the election.
Right. So they got to do it now. They need that market to jump. I will bet you a latte. Okay. My latte at Starbucks is currently $5.62. It has increased from around $4 2 years ago, and they've cut back on their rewards for their customer disloyalty program. We're supposed to be loyal to them. They're disloyal to
us. Yeah.
But that's business in America today, right? All right.
So trying to make a buck,
Hey, they got to do something here.
Yeah.
This is the only thing they got. Well, I guess they could just print up a couple $1 trillion and just dump it into the market, right?
Well, that's coming. I mean, during the next recession, and I believe a recession is going to take hold. The slowdown in the economy has been very, very gradual. I think it's going to persist. There's the next couple charts just down below where we are, Kerry, underscores this in terms of, again, looking at the labor market. The savings rate now, for instance, is down to 2.9%. Prior to the pandemic, it was about 5.5%, between 5 and 6%. So the economy's still moving forward, but there's a whole lot of people that are spending, but they're not saving because they don't have the extra income to be able to do it. So there are stresses building in the economy. And if you could just tick down to the next two charts, because, this, okay, so the one on the left is diffusion index. It's kind of like, okay, how many sectors are really contributing to employment growth? Well, it dropped below 50% last month. I haven't seen the number for this most recent month.
It's bad.
So again, you look back in time when fewer and fewer industries are, adding jobs. You're on the cusp of a recession. The monthly hours worked, you can see, that's slowing, and that is progressive. I think that's going to continue. So my point is, irrespective of today's number, the die is cast as far as I'm concerned. The unemployment rate's going to tick up, and the labor market's going to weaken, and ultimately, I think we go into a recession as we get into next year.
Hey, well, don't worry about it, because AI is coming to save the day, Jim. We're all going to be saved. It'll save the U.S. economy, the global economy, because Elon Musk says so, right?
I don't agree with that, but again, AI is going to make a difference. The problem is, and I wrote about this a couple months ago, and talking about the semiconductor stocks and NVIDIA, that is $50 billion was spent on NVIDIA chips. So far, companies employing AI have generated $3 billion in revenue. So that we're at a point where people are going to start to question, we're spending all this money and we're not really seeing much bang for our buck, which then begs less spending. I think that's the technology weakness we've seen, Kerry, is people are waking up to like, ooh, maybe we're not going to get the return on all this money as quickly as we thought.
Well, one industry that is really cashing in on the AI boom is the energy industry, the electrical industry. Now, I don't usually tell people when I buy stocks when I sell them, because I'm not a financial advisor. I don't give advice. And, I'm no expert on it. But I did happen to buy this stock a couple months ago called Dominion Energy. And I didn't buy it because it's financials. It's a solid mid-tier electrical utility. that pays a dividend of, 2.7%, something like that. Yeah. The reason I bought it is because all the government data centers are in like Langley, Virginia, in that CIA strip over there. Yeah. And they are piling in. They're probably buying more NVIDIA chips than Tesla and Musk combined. And sure enough, I was starting to wonder, it's only up like 10% in what the market's been doing. Plus, I got paid to wait.
Yeah.
Sure enough, there was a news release saying that, hey, if you want to build a data center here, you got to make a reservation because we're all booked up. You can't just build one because they use like 500 megawatts, which is like enough to power the state of Rhode Island, you know?
Mm-hmm. Yeah.
And they're cashing in on it, obviously for intelligence and such. Hey, man, they'll just get rid of like all those analysts who just take up space and, right?
But it's like the gold rush. People who really made money in the gold rush were the people who sold the pickets and shovels and all the rest.
And Levi Strauss. Don't forget Levi Strauss.
Got to have some G's, baby. So, the utility are seeing a huge ramp up in demand for energy, and they should be beneficiaries. And at least at the same time, if the economy does slow, the decrease in demand because the economy is slowing is going to be offset to some extent by the increase in demand to be able to power AI and everything associated with it. So that was a good thing.
Everything too. I mean, the robots are coming, and I have no doubt those robots are going to be super useful, especially in Florida here. Hey, I can't walk, but my robot can go like get me a cigar, right, and light it for me. Cut the tip. That's the robot I want. The one that will pick out the cigar, cut the tip, put it in my mouth, and light it. And I can't do anything here, Jim, you know?
And then flick the ash. You got to have the ash.
Of course. Yeah. Got to flick the ash, clean up after me, because, of course, I'm, infirmed. I can't, do everything. No, but seriously, those robots are coming. There's no question, and it's going to be revolutionary. We're right when the .com bust happened. Right? Nobody thought after that, the internet's not going to amount to anything. Yet, these trillion-dollar companies all came about as a result of that. That's where we're at now, where the return is going to lag the investment. But then when it kicks in, I see it with the Tesla cars. I have a big Tesla fan, not because I think I'm saving the planet, furthest thing from my mind, but the tech. And that thing basically 90% of the time, Jeff, it's driving itself.
Sure.
I'm monitoring it. I'm like the pilot. So the pilot is the car, and I'm the monitoring driver. And when it does something I don't like, I knock it off and I take the control. Yeah. We're not that far here. And according to Musk, we're going to be having these things.
Yeah. No, I mean, all those things are coming, as you point out. I tell the story about RCA because I think it's applicable. Radio was a huge thing when it showed up, and RCA was at the forefront of radio. It had radio stations all over the country. In 1921, RCA stock was $8 a share. By 1929, it was $467 a share. And it went up because people were like, oh, God, they're going to be able to send pictures, and you'll be able to see people talking and not just listen to them, okay? In 1932, it was $15 a share. Now, obviously, the Depression had a little something to do with it. My point, though, is did TV stations happen? Did RCA fulfill, if you will, the promise of the 20s in terms of what was coming next? They did. So what happens, though, is you get into these phases where people get so enamored about what might be coming down the road, they're more than willing to overpay in the short term. No, and I just think that's where we've kind of been. And ultimately, what you're talking about will, like the internet, after the unwind between 2000 and 2002, and then you flash forward 20 years, and you've got several companies that are worth $3 trillion.
Okay, so and that is so true, because it's the lag between the promise and the delivery, and people buy the sizzle, not the steak. So Buffett's dumped $7 billion worth of BOA. He sold off half his Apple holdings. He's got $277 billion in cash right now. So he could basically buy Elon Musk, and put him on a raft out to Africa or whatever. Are we going to see a return to real value investing here?
Yeah, it's going to take time. I mean, at the beginning of the piece that you're posting on your site is I'm offering a special report, the coming secular bear market. And in that piece, Kerry, I go back through history and then look at what's going on in our economy that has been going on that is going to require, if you will, a big adjustment. And that adjustment is going to be valuations are going to drop from very, very high levels from an historical standpoint to a much more reasonable level. And as we deal with these problems, the economy is going to grow more slowly. Well, that means earnings are going to be less. So you get a combination of factors that bring stock valuations down. The parallel I would make is between 1966, 1982. The Dow got to 1,000 in 1966. In 1982, it was trading under 100. Under 800.
Yeah, it was
16 years later.
70 something. I remember. Yeah. 70.
Yeah. But it took a long time and there were a lot of ups and downs as that process got worked through. I think we're on a cusp over the next 10 to 15 years where we're going to see a secular bear market. There's no way the government can continue to spend and have a deficit 7% a year while the economy's growing. 125% of debt to GDP, and it's going higher. Those things have to be addressed and will be addressed. And I think the outcome is that equity valuations are going to get compressed.
Hey, so just to let you know, AI, I solved the budget problem, by the way. I told ChatGPT to cut $3 trillion off the budget. And the first thing it does, because it has a certain leaning, is it doesn't say anything about budget cuts. It wants to raise the tax rate on business from 21 to 28%. So I said, do not under any circumstances raise taxes. All right. And then I said, get rid of 100 government agencies. And you know what? I saved trillions of dollars here, man. And I didn't even have to look at it.
Yeah. And the reality is, Kerry, I mean, to be serious about it, in the sense is we got to this problem because of too much spending, no question about it. And tax levels are lower. I just think if you want to get serious about bringing the deficit down, you have to curb spending and you need to increase some taxes.
Of course.
It's painful ideologically.
Surgery.
It isn't. I mean, ideologically, the Dems aren't going to go for the spending cuts and the Republicans aren't going to go for the tax increases, which is how we got to here. So that, if indeed that happens, you spend less money, you raise taxes, there is going to be slower economic growth.
If we had cut spending 20 years ago by 10% and just, we wouldn't even have these deficits now,
Yeah, no, I mean, it's called discipline. I think going the last 50 years, tax receipts have averaged about 17.5% of GDP. Mm-hmm. Spending is around 20%, so you still had a deficit. But we're at 23% to 24% of GDP in terms of spending. So if there was more discipline on the spending side, the deficits would not have been or be. Now, the sad thing is both candidates are not talking about reducing deficits whatsoever.
Well, Trump is, to the extent of he wants to put Elon Musk in charge of cost savings commission. But I think there's a realization that's dawning that the deed's going to have to be done. And that's the problem. When you don't discipline your child when they're 6, when they're 20 and they're in college and they're not going to class, it becomes impossible. Anyways, let's just look at another chart. I want to look at gold.
Yeah, gold. All right. From the low of last year, gold bottomed at 1812. I think we're nearing the end of that big move up from 1812. I still think there's a potential for one more pop above the 25, 29 high that happened a few weeks ago to complete this move. if gold trades below 2470, that probably reduces the chance for another pop. My guess is and part of this too, besides just the price pattern, bullishness on gold is quite high. Positioning is, large speculators have a very big position long in gold because people have been talking about gold going to 3,000. It may indeed go to 3,000. I just think in the short term, people are overextended toward gold. I think that we're going to see a pullback in gold, 2,300, 2,350.
Consolidation.
More consolidation than, oh my goodness, the sky's falling. In terms of the dollar, I think the dollar's headed toward the mid-90s. I think near term, you might see a little bit more strength, but I think we're going to take out that recent low. Then there'll be another bounce. But ultimately, I think, Kerry, the dollar dropped about $13.50 from 114 to 101. You take $13 from that high at 107.94. So, in other words, two declines that are relatively equal, and that's how you get down towards 95. If I'm right about the economy slowing more, going into recession, the Fed being forced to probably accelerate rate cuts, I think that's this is why I felt really for the last 2-3 months, the trend in the dollar was down. It was just how we were going to get towards the mid-90s.
Okay. All right. Hey, you got more charts. We're going to
put more charts. Again, I put these charts together a couple hours ago, and Waller made some comments. He's a FOMC governor. So TLT rallied above, I think it got up to maybe 100.70. What I basically told my subscribers to Macrotide's weekly technical review, we've been long since the spring at 91.13 to sell a third of their position above that 99.93 because we're getting a little overextended in the short term on TLT. And, sell the news. The Fed does cut the rates. Potentially, if they only go 25, not 50, that gives people a reason to sell into the news, so to speak. Longer term, I still think 105, 109, and the possibility is if we really do go into recession, 119 is possible. So I'm looking to be a buyer on a pullback over the next, or a couple months if that pans out. And then finally, the S&P, once it dropped below 55.61, you can see that's important support. It held it twice. There's still the chance that the S&P will be able to go up one more time to a new high. Now, what I said in Monday's weekly technical review is if we do get the rally above 5,700, that's going to set the stage for a decline to 51.50 to 49.80. In other words, that low we saw in April, I think if we did get this pop, we're going down there. We may not get the pop. We may be just going down there directly because people are realizing, oh, great, they may cut more if the economy's weak. And the premise of this rally the last 2 months or so, Kerry, was, hey, the economy's okay. We don't have to worry about a recession and the Fed's going to cut rates. Well, now all of a sudden, the idea that the economy's fine, I think, is being called into question. And even if the Fed is going to cut rates, people are looking at that as like, that glass looks half empty, not half full. Yeah. So,
Okay, I'm buying.
Okay.
All right, Jim, we got to run now. Macrotides.com. The link to these charts, if you're listening on the podcast, is in the show notes. Just click it. You'll get it from my Dropbox straight to you. And look, go subscribe, macrotides.com. You can send me an email at kl@kerrylutz.com if you've got a question or comment. Very interesting conversation. Jim, as always, we appreciate your joining us here, and we'll talk to you again when the fallout happens, if we're not all in our fallout shelters.
Well, we'll see what the Fed does on September 18th. This was a fun conversation, Kerry. I enjoyed it, and I hopefully listeners as well.
Always. Hey, by the way, you'll find a link to macrotides.com in the show notes to this interview on financialsurvivalnetwork.com. Hey, while you're there, please sign up for your free newsletter so you get information like this. Jim, you have been ahead of the curve. We've been talking about this for like a year and a half, and it's all coming to fruition. Appreciate you.
Thanks very much, Kerry. Have a great weekend.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network. Now more than ever.